So welcome everyone to our webinar on the investment trends findings of 2019 and 2020. So I think, as we can already start. Well, first of all, I'd like to thank Get Invest for supporting this exercise that we're doing today, where we will be discussing on the trends and the main insights that we have identified in the Google Investments Database for 2019 to 2020. I guess if you're here, you've already probably seen the report or you follow Google. I really encourage you to go through, of course, the report that we've published, but also there is a website that's quite interactive where we have shared all the historical data where you can navigate the breakdowns in terms of investments and who they went through, who was the funding concentration, etc. But the idea today is more to clarify all the questions that you might have as you go through that report or as you go through that data directly with Google and with Catalyst of grid advisors who have been commissioned to do this exercise. Thanks. And for the objectives, the rationale, and the scope of this exercise. So for the scope, we have tracked investments from 2019 to August 2020, so to the first half of the year. So that's our what. In terms of the why and why we did this now, we wanted to understand what the investment flows were, as investment flows are critical for this sector and for a sector that's growing. And we also wanted to understand what was the effect of COVID-19 on the investments in off-grid solar. A few other objectives that we had. So for this specific iteration, we focused quite a bit on doing an investor survey and understanding what the investment sentiment was in the sector, but also to increase the awareness of what the investment trends are in the off-grid solar industry and to gather a broader audience. And then, of course, to identify where the funding gaps might be as we move forward and we navigate COVID-19. Yeah, as I said earlier, I encourage everyone to ask questions. So we will have two different moments for Q&A during the session. The session will be recorded and will be shared afterwards. If you experience any problems, let us know via the question box, and we have a hard stop at 5 p.m. So the webinar will last 60 minutes. And we're launching a poll now. I want to get a feel of who the audience is, who's listening, who's behind. So yeah, you'll see in a bit the poll in your screen. So yeah, please select the description that best fits your organization and who you represent. I think while you're voting, we can maybe move to the next slide. I'm not sure if we can do this. That's great, thanks. So for the flow of what we're discussing today, I'll be moderating the session. Laura Fortes, I'm Project Manager of Access to Finance at Google. We're gonna have introductory remarks from Koen Peters. And then we're going to have Dan Murphy from Catalyst of Grid Advisors presenting on the main findings. So maybe before Koen starts, if we can check on the results. It seems we have a good divide among investors and companies. 14% of development partners, associations, and then 22% of consultants, research institutes, others. So I'll give the floor to you, Koen, and thank you so much, everyone, for listening in.
Yeah, thank you very much, Laura. I'll keep it brief so that we can quickly move into the the details that Dan will share with us. As Laura mentioned, we've been doing this deals database exercise a couple of times. This is the fourth time that we have hired consultants to work with us and to get a good picture. We think a fairly robust and complete picture of what investment has flown into the off-grid space. We've done it with different funders every round. Get Invest has been supporting us now for the second time in this fourth exercise. Thank you very much, Get Invest. For us, this information is really helpful and important to be able to paint a good picture of where the industry stands, and that helps, of course, in our advocacy work and in reaching out to governments and investors and explaining them on how they should support our sector, why they should support our sector, and where. But we also think this is very valuable information for companies as they try to understand how they're doing relative to other players in the industry. And we think that that's very helpful for them to speak to their investors and their board members. This year's round was a little bit delayed as we were planning in March our round. COVID hit the industry, and it all seemed very irrelevant to look at investment numbers in 2019 when the world was so shaken up. So we paused a little bit and decided to do it a bit later. And a few months later, we got out of the starting blocks with the exercise and decided to add an investor survey to also get a feeling not just of the hard numbers, but also of how investors are looking at the market as we are progressing through the COVID pandemic. And what we hear from our members in Africa and Asia also already starting to come out of it to a certain degree. The data that we got from this has given us interesting data, and is filling in the picture that we're making up with other data that we're collecting as well. The consumer research, if it's 60 decibel, the sales data work that we've been doing for a long time, and which we are also now putting together for the first half of 2020. And the surveys that we did among our members and other industry players. And the picture that is emerging is interesting. On a headline, the numbers in terms of investments seem to be holding up, and 2020 doesn't seem to be so much of a different year compared to 2019 and 2018. But if you scratch a little bit further, then underlying that main story, there are clear challenges that the industry is confronting, and that we should be able to address if we wanted to make sure that the industry is helping to contribute to the Sustainable Development Goals. There's one picture that is clearly emerging, is that the industry is ready to bounce back, and some members are telling us they are already bouncing back and seeing that in their sales. I think the sector has remained resolute and resilient throughout the industry. Also, thanks to industry and investors finding each other easily and coming together as a sector in ways that are really very encouraging and really very positive. Still, looking forward, there are many challenges. The industry is there, but it can't do it alone. We need to work together with impact investors, with donors, and governments to really make the best of this industry. With that, I'd like to pass on to Dan Murphy to talk us through the detailed findings that Catalyst has dug up in their research and that they are sharing with us in this report. Dan, over to you.
Great. Thank you very much, Koen, for your introductory remarks, and Laura as well for yours. And before I get started into the key findings themselves, just a little bit of additional context in terms of how we undertook this work this time around. And as you can imagine, we did quite a bit of desk research in order to source the transactions that happened over the course of 2019 and year to date through to 2020. As Koen mentioned, we also jointly conducted a survey with investors that we'll talk through a little bit later. And I think the third key piece of our research was to conduct key informant interviews with about 25 investors and companies in the sector, and we took a very deliberate approach to selecting those businesses and those financing partners to make sure that we had as broad of a footprint and a snapshot of the industry as we could through those interactions. And I think on balance, we've managed to compile a pretty comprehensive snapshot, as Koen alluded to, of the overall financing landscape for the off-grid solar sector. Just in terms of also related to the scope, as Koen mentioned, we covered all of 2019, and we also covered 2020 through the end of August. So any transactions that were announced in September and beyond are not tracked in the database, though there are a couple of exceptions, which I'll mention as we go through the slides. So that's it for me by way of introduction, but if we could move to the next slide, we can roll up our sleeves and get into some of the interesting details here. So first, to start with the good news and talk about 2019. So 2019 on balance was a very robust year for the sector. As you're seeing here, there were $312 million of total commitments in the year. And that end of year total actually came out 20% higher than the projection that had been put forward in the market trends report that was published in early 2020. The reason for that difference is that there were some additional transactions late in the year that were announced, and through our extensive scraping exercise, we identified additional transactions beyond those, some of which were not publicly disclosed, which is what led to that difference. The other good news is that there was a lot of investor activity. So the second largest level of participation for the industry to date, with 47 investors making commitments in the year. And on the company side, again, it was robust, with 50 companies benefiting from transactions in 2019. So 2020, again, as Koen alluded to, really is telling a very interesting story, in that what we're seeing is that very robust commitments through the year. So as of end August, $199 million of commitments, and quite interestingly, pretty active on the investor side. So 33 investors have participated year to date, and which is an interesting contrast to the 5-year trailing average of 38 investors per annum. And then perhaps most striking is that 62 companies have in fact benefited from financial support in 2020. So, all in all, despite COVID-19, things are looking pretty robust. And I think what we're seeing behind these numbers is the reality that a lot of these transactions may have been legacy transactions from 2019, particularly as the industry has matured. These larger ticket transactions take quite some time to structure, negotiate, and close, and therefore, we were seeing those being announced in 2020. That notwithstanding, I think the sheer volume of businesses receiving support is quite promising, and I think speaks to the broader resiliency of the sector. Let's move to the next slide, please. So in terms of geographic diversity, we continue to see significant concentration in sub-Saharan Africa, and what we're seeing is that West Africa in particular has started to pick up a bit from East Africa, where the majority of the deal flow historically has been focused. And as you're seeing here in in 2020, West Africa is in fact eclipsing the eastern side of the continent in terms of total commitments. And it's important to note in the top left corner that those global transactions, which it's quite a substantial volume, it's about $200 million of deal flow over the 2 years. And those are transactions that are committed into vertically integrated businesses where it's not easy to directly attribute those investments to any given geography. So if we actually strip out those global investments from the total, sub-Saharan Africa is in fact capturing over 90% of commitments over the 2-year period. In fact, I think it exceeds even 95%. Let's move to the next slide, please. So in terms of the blend of commitments, again, very interesting to see how things have evolved over the past couple of years. I think on the equity side of things, we have seen equity basically maintain the same level across 2018 to 2019. And obviously, you're noting the significant tapering in equity in 2020, and we'll get into the details on that in a moment. And then on the debt side as well, things have stayed relatively robust again from 2018 to 2019, and then particularly in 2020, we're seeing really significant flows of debt into the sector through the year. Let's move to the next slide, please. So I think in terms of the key features that I want to mention here across the 2 years, and just to say that these deltas that you're seeing are relative to the trailing 3-year average. And again, what I want to point out, first of all, is the number of investors that are participating in the sector, which continues to increase relative to preceding years. And then I think most importantly, this diversification that we're seeing in terms of the number of companies that are receiving at least one investment. Obviously, it's up for debate as to whether 62 businesses are sufficient. I think several folks in the sector would argue that there needs to be many more businesses that are receiving financial support. But again, that's a matter that we can go into detail later when we have a chance for a bit of an open discussion in the Q&A. Let's move to the next slide, please. So this slide has certainly been the headline so far for this report, for better or for worse. And what this slide is showing is the commitments into the top 10 recipients of financing in each year. So it's the top 10 in dark blue and the top 3 in orange. And in terms of the top 10, we've seen remarkable consistency throughout the years in terms of the concentration into those businesses. So again, in 2019, we saw 90% of all commitments going to the top 10, relatively consistent in 2020 at 88%. And then the headline that's been picked up in the press, at least around this report, has been the top 3 and the market concentration in 2020. So with those top 3 businesses having received 75% of all commitments in this year. Let's move to the next slide, please. So with respect to equity, again, we're seeing a really interesting transition over time. So in 2018, what we were seeing was for-profit finance. So basically, you can take that as a code word for private equity, larger institutional investors that have come in to provide growth stage equity into some of the legacy businesses that have been in the space since its earliest days. And that's a very positive sign and a very positive evolution that you have PE coming in, recognizing the commercial viability of the sector. And then what we've seen in 2019 was a real significant arrival of strategic corporates coming in, again, providing equity into off-grid solar businesses, recognizing the interesting market opportunity that lies within the sector. And the other thing that's interesting is that we have seen a tapering of DFI equity investments from 2018 to 2019 through to the present. In 2020, what's been really stark, as you can see here, is that investments have tapered significantly. One could even go so far as to say fallen off a cliff. So there has only been $31 million in equity commitments in 2020, and on 14 transactions. So the average transaction size is quite small, and the vast majority of those transactions are in fact convertible debt. And convertible debt signals one of two things. Convertible debt is tagged, and rightly so, tagged in the Global Deals database as an equity investment. Though it is a debt vehicle, it's intended to function like equity, and it's an appropriate investment in particular for early stage businesses, and which may explain some of the smaller sort of average transaction size of these equity deals. And then the other way that convertible debt is useful is for larger, more established businesses that are getting bridge financing. So a shorter term round of financing to bridge them to a new round, for example, of equity. And it's quite common for that to be structured as convertible debt, so that you don't have to go through the gymnastics of doing a priced round and evaluation. You basically defer that pricing and valuation until the subsequent financing round after the bridge itself. So let's move on to debt. Again, on the debt side of things, we've seen pretty consistent trends in terms of the blend of types of investors that have been coming in, and also pretty consistent in terms of the flows of that capital, particularly from impact finance and from development finance institutions. And I think that's quite encouraging. And then the other thing that has been quite striking, certainly starting in 2018 and which continued into 2020, was the prominence of crowdfunding into the space. And in 2019, there were a total of 92 debt transactions, and of those, 70 were crowdfunding transactions. And those 70 transactions represented 14% of the total commitment. So that really underscores both the volume and velocity of those deals, and the fact that those are considerably smaller tickets as well that are going into those businesses. And then, the other interesting, sorry, just still on debt for a moment. The other interesting remark here is in 2020, you see that the crowdfunding commitments have tapered significantly. And what's quite intriguing there is that the vast majority of those new crowdfunding commitments are actually refinancing of existing deals. So say a 2018 vintage crowdfunding transaction that was set to come due perhaps in 2020 has in fact been rolled over and refinanced into a new transaction. We can move to the next slide about grants. So with grants, this also paints a pretty stark picture, I think, a positively stark picture in terms of what we're seeing in 2020. And I think what's important to understand here is that 2020, the total figure of $27.5 million is largely attributable to a single large grant making program, which is the Africa Enterprise Challenge Fund, which had not made commitments over the past couple of years, and one could argue that they had a bit of a backlog in terms of new commitments that they were able to unlock and make in 2020, and that's why we're seeing this significant bump. And so what I would encourage participants to do is to take that 2020 slice and probably more evenly distribute it across the preceding couple of years. And I think that levels out the story a bit more in terms of what's happening on the grant side of things. Again, here, I think it's really important to underscore the how critical grants are for the sector, how critical grants were for the sector back in its early days, and the fact that you have established companies moving into new markets, experimenting with new customer bases, new products. All of that is quite risky, and ideally would be at least in part funded through grants. And then of course we have the newer generation of off-grid solar businesses, particularly with more of a local distribution focus, that are entering the scene, and again, who really need to benefit from highly concessionary grant financing to prove out the business model before they can scale like their elder peers. Next slide, please. So here what we did was a bit of a simulation to forecast out likely scenarios or plausible scenarios through to the end of 2020. So what you're seeing, that last blue block, year to date 2020, those are the actual commitments, 199 million as of August 31st. And what we first did was to extrapolate that forward in a base case. So take the same pace of commitments year to date and push that through to the end of the year. And that puts us at $298 million of total commitments on the year. We then mapped out a bear scenario whereby that pace of commitment through to the end of the year drops to 75% of a pace to date. And that yields 273 million of total commitments on the year. And then we did a bull scenario, the inverse of that, with a 25% bump over deal flow year to date. And that put us at $323 million for the year. So I think I'll pass back over to Laura here. I think we're gonna hold a bit of a poll here to see what you all think, which scenario is most likely to materialize.
Yeah, I think we'll be launching that poll now. And then while you're responding, then it's a good opportunity to address some of the questions that are coming in. So the question would be, there are a few questions on geographical divide. So actually there's a question on if you think we've seen 50% of the investments go through East Africa, and whether West Africa uptick you think there's any reason that investors are more lean to investing in the West African region?
Sure, thanks. I think that's a great question, and I think the numbers are showing the expansion of the business model, both again with some of the legacy vertically integrated businesses that really cut their teeth in East Africa, now securing the financing that they need to expand their geographic footprint. And a lot of that expansion has been into West African markets, which up until the past couple of years have been relatively untapped and very low competition in several of the markets, at least up until recently. So I think that's one way of explaining things. And the second is that, again, I think what we're seeing is the new generation of more specialized businesses that are focusing on the distribution side of the business, and that have really focused on some of those greenfield markets where there hasn't been as much competition in West Africa. And so that's what's led to that bump. And I think what we'll continue to see is probably going forward additional bullish volumes of capital moving into West Africa. And then I think things will start to even out between the West and the East. The East is pretty saturated in some ways. And I think that once West Africa reaches that level, we'll see a more balanced flow of total commitments and blend of commitments into those two geographies. And I would also expect that Southern Africa, there's lots of attractive markets in Southern Africa that will also see a bit of a bump over the coming years here.
Absolutely. We see that as well. Growing markets also from our sales data. Maybe we'll have time for another question here. So to what extent then do you think that the strategic corporate's entry in 2018 will influence the volumes of deals in the next years and in the future? Will companies move to raise capital internally, or which will not be visible in this data? It's a pretty interesting question.
Yeah, that's a great question. And for one, to be honest, I don't have the answer to that, certainly not definitively. I think that, those businesses that have brought in strategic corporates, it really depends on the nature of that partnership. And, we have seen full acquisitions in the sector, which in those cases, those acquisitions may lead to what you were just describing, whereby future financing of the business is met in-house through the parent company. In contrast to that, I think some of the strategic corporate investments, that more recent ones that we've seen, have been, straight equity positions, either minority. I believe all of them are minority positions into those businesses. And so I think we can reasonably expect those businesses to continue to stay active in capital markets, both for certainly for debt raises, and quite possibly they'll continue to bring in equity from other investors beyond the strategic corporates with whom they've recently partnered.
Great. And then one more related to this, how we see the equity round in the coming years. Down rounds might happen, or M&A would be expected by a successful player or large corporate, as relates to this one.
Sorry, could you repeat the question, Laura?
How would you see the equity round in coming years? Down rounds might happen, or M&A would be expected by a successful player or large corporate, and what are the consequences of that?
Yeah, I think that both of those scenarios are plausible. Again, there is a possibility of down rounds, particularly in the sort of frothy equity market that we're in right now. I think equity investors are waiting to see what the longer term impact of COVID and by the ancillary impacts of COVID on the industry. And so that certainly is possible. And I think that as the legacy businesses that have been in the space for quite some time, I think it's a very positive sign that you've seen strategic corporates come in, that you've seen the acquisitions. I think certainly for those businesses that have proven themselves, that's an important opportunity for liquidity events for the existing investors to to realize those gains, and those are the kind of proof points that the industry really needs to continue to attract those type of investors into the space.
Yeah. Cool. We're receiving quite a few questions, but I think let's move on, because we still have a little bit of the presentation on the investor perspectives. Then in any case, I'll be curious if we can launch the results of the poll first. And then I'll give the floor back to you, Dan, to analyze what you see here, which is that 45% equally thinks that it's either a bear or a base scenario, and only 10% see it as a bull scenario, which kind of contradicts a bit the investor perspectives that were quite still supporting the sector.
Yeah, this is an interesting snapshot, and I think not entirely surprising for those of you that may have read the report. We actually speculated that the bear scenario would in fact prevail, although I also now suspect that we may be proven wrong. There was a couple of large announcements made after the August 31 cutoff. There's about $40 million of new deal flow that's been announced that hadn't been tracked. I do want to note here that the large Greenlight Planet blended debt and equity transaction, though not announced, we had in fact tracked. So had we not, that would have blown our bear and bull scenarios out of the water. So yeah, I think it's going to be interesting to see what new announcements are made through to the end of the year. I mean, based on our market soundings, we weren't aware of any additional large transactions that were on the cusp of being announced through to the end of the year. But I wouldn't be surprised to be proven wrong, and we'll see where things land. So we'll shift over now to the investor perspective. So as I mentioned, one of the activities that we undertook as part of this work that we felt was really important was to survey investors in the space. And as was mentioned early on, there was the enterprise facing survey that was undertaken by GIZ and Dev colleagues, which I think is a very useful company perspective. And then you have the customer perspective from 60 decibels. And we felt it was important to go out into the market and solicit views from investors. And the way that we did this was to only solicit active investors in the space. And we only solicited a single person within each of those organizations to participate in the survey, so that we had as balanced of a snapshot as possible from current investors in the landscape. So let's move to the next slide and we can walk through a little bit of what this is telling us. I think first, what's noteworthy is that we had a really nice blend of profile of investors on the top left in terms of the types of organizations that they represent. On the top right, the type of capital that they commit into off-grid solar, both grants, debt, and equity. And then also on the bottom left, you're seeing that we had a really nice split again of the stages of businesses that they look to support, from very early stage to, in fact, mature companies that are looking to raise growth capital. And also in terms of financial returns, I mean, all the investors are looking for positive returns with, varying degrees of market adjusted return rates. So let's move to the next slide. And I think, the headline here is that off-grid solar investors are quite optimistic and bullish about the sector. The view before COVID-19 emerged early in the year was that in general, the sector was meeting expectations from a financial return perspective. And we know that broadly, investors in this space are also investing in impact in SDG 7. And broadly, we're satisfied with what the industry was doing on that front. If we look to the top right, what's quite interesting is that the majority of the investors have in fact made investments since March of 2020 and have really leaned in. And, I suspect that the bulk of those have been additional financings into existing businesses in their portfolio. I think there are a couple in there that are new greenfield transactions, new businesses coming into portfolios as well. And again, moving to the bottom left, what's quite striking is that investors, again, signaling their bullishness, the vast majority are in fact looking to increase their exposure into the space. And on the bottom right, what we're seeing is that most of them don't have much dry powder left. And I think this is indicative of the fact that those that did have the dry powder have in fact leaned in, as you're seeing in response number 7 above, and supported businesses already. Next slide, please. So with respect to COVID and its impacts, I think, investors are primarily concerned on two fronts. First is on the revenue side and the ability of existing customers to pay, which is critical. And then related to that, there are concerns about the ability of off-grid solar businesses to actually acquire new customers. And I think what's really important there is that not only do you want to acquire new customers, but you want to acquire good payers so that you're not just fueling the primary concern of investors above. And then I think the secondary concern, relates to the enterprise side of things and concerns about liquidity of the businesses themselves. Do they have enough cash on hand, enough runway to make it through the crisis? And concerns of investors, perhaps longer term, around the ability of businesses to go out to the market and raise additional debt and equity, which they're going to need both to make it through the crisis and also ultimately to thrive on the back end and continue to grow over time. And then, not surprisingly, if we look across to the bar chart on the top right, so response 14, investors are primarily banking on impact. Not surprisingly, that really is the disproportionate driver for them. And if we move to the bottom left corner on response 13, in terms of the risk profile of the sector, by and large, investors see that the overall risk is likely to increase, and that's not surprising. But I think that despite that additional risk, what we see, at least among these respondents, is a willingness to stay engaged and continue to support the sector. And then, the final, well, actually, yeah, it might be more interesting to jump to the poll first and see what you all think about the stage at which you consider the off-grid solar investment market to be in. And so this was the same question that we asked of investors, and be interesting if folks would give their view on whether they see the sector as still in its infancy, about to take off, whether it's growing steadily or perhaps fully established.
Thank you so
So
much.
Laura, I'll pass back to you.
Thank you so much for the presentation, Dan. It's been really interesting to do this exercise and be surprised by the evidence that we have seen in the sector. So while the audience is on the poll, we can move to the Q&A. So we have received quite a few questions. We'll try to respond as many as possible. I think, Dan, if you could turn on your video, that would be fantastic so that we can see you again. There's a question from Nico Yavi saying that it's very interesting that crowdfunders did 70 out of the 92 debt transactions last year. How many different companies were those 7 transactions deployed to, given that the high number can be explained by crowdfunders doing several crowd rounds per actual transaction and company. I think, Dan, if you could, you can unmute yourself. You're still on.
Sorry about that. Nico, it's a great question, and I don't actually have the answer to that at my fingertips, but what I can tell you is that what we did see were some companies that were getting several repeat rounds of crowd campaigns, and somewhat surprisingly, those companies were frequently some of the larger, even vertically integrated players in the space that have gone over to the crowd to source some of their debt. And then I think, in contrast to that, I think there's also been a nice diverse blend, lots of different businesses that were able to tap into it, even if those were one-offs. And I think certainly crowdfunding on the debt side, I think, can be one path to fostering more diversity in terms of the number of businesses that are benefiting from financing support. And obviously that relates to and links directly to kind of the risk tolerance of those investors, and also the minimum ticket sizes that those investors are willing to consider, which obviously dictates the stage and size of business that they would be able to support.
Cool. And there's a next question that I'm going to address to Koen. As we've seen since we published the report only on Thursday, that basically the investment concentration has really made the headlines. And then, yeah, we've seen that the top 3 companies that receive funding this year represent the 75% of the investments. So yeah, I'd like to ask Koen, what's your view on that? And how should we respond as an industry to this?
Yeah, thanks, Laura, for that question. On itself, it's funny that should be the headline that people pick up from the report, because that's actually that wasn't new. The concentration in the top 3 countries and the top 10 countries has been fairly consistent throughout the years. 75 is high compared to previous years, but it has always been a pretty concentrated market. What is also worth mentioning is that it's not always the same 3 companies and not always the same top 10 companies. Those companies differ from one year to the other. Unfortunately, we can't name that in the with the agreements that we've been given to companies to share information. So people will need to dig in the social media for announcements to figure out for themselves which companies they were, and might be able to pick that to put that picture together themselves. But the concentration in the market, of course, is a concern. I should also flag that the number of deals relatively had gone up. The deal size, the average deal size had gone down. So there's also a trend in the right direction, or in a somewhat positive direction, that more companies have been able to access smaller tickets of funding, which on itself is good news. Having said that, on the full picture, we've been playing around with language around how do we call this situation. Are investors bullish? Are they supportive? Are they confident? We should count ourselves really lucky that the news around COVID is not as bad as we thought it could have been, and we should count ourselves really lucky that we have a very supportive community of investors that have really been looking after our companies and really trying to pull together and invest in this space. Still, if you look at the investment numbers over the last 3-4 years, and you think about how this sector could contribute to sustainable development goals and impact, I would hesitate to use words like bullish, because we are not there where we want to be with investment. The concentration is one of the issues, but overall equity financing, we've been discussing that for many years, has been a concern. Debt funding has been on the rise. That's good news, but it's debt funding for a small number of companies. Grant funding has been better this year, but we've also been telling the donor community that we think a higher share of grant funding in the industry is justified given where the industry stands. So yeah, that 75%, the concentration is an issue, is not new. Also the other financing challenges in the industry are an issue. They are not entirely new. What is positive here is the resilience of the market, and I hope that we can see some further growth in the future. Clearly, the industry is ready to bounce back. Having said that, and maybe Dan, worth for you to comment on whether this is something you picked up from investors, what is needed. What we think is important that we really make a step change in the transparency that the industry is showing on the performance of that it demonstrates. If we want to really access a next layer of investors, particularly local debt providers, they probably don't get the information out of the industry that they'd like to see to really understand how the industry is performing. Dan, is that something that you picked up from your interviews?
Thanks, Koen. Yeah, I would say in general, what we heard from investors was a desire and a need to particularly have a better understanding of the financial performance of the businesses, particularly with respect to their portfolios of consumer receivables. And I think that's where, you know, the industry-wide Pay Go Perform initiative is absolutely crucial, and really needs to be an area of focus for the industry and for all companies in the space to align around those metrics and begin to use them so that you can have that cross comparability and have everyone speaking the same language about what performance looks like when it comes to those receivables. So I think that's definitely something we heard. And Koen, I think that your point about, you know, bullish being kind of too strong a word is spot on, right? I think that it's great that the existing investors whom we surveyed are bullish and continue to stay engaged. That's fantastic. And ideally, you know, they'll be compelled, and their institutions will be compelled to do even more, as you said. And I think what the industry really needs to do is continue to find that step change to identify whole new cohorts and categories of investors. And I agree with you that, you know, local debt, local banks are important. I also think that there needs to be a whole new cadre of grant capital that comes into the space, you know, very risk tolerant early stage capital. And then on the equity side as well, I think we need both, you know, more strategic corporates and growth stage equity to come in. But I think the real dearth out there right now is the very risk tolerant, very early equity that needs to be in there to seed new businesses across the globe.
I wish it would have been a closing almost, but we have a few more questions to go through. And this one is for Dan. From your analysis, is there a reason why there has been such a decline in equity investments when there is such palpable need in the market?
Thanks. I think, again, I think that's attributable to a couple of things. One is the fact that 2020 is particularly on the equity side reflecting largely legacy transactions that were structured in 2019 or in early 2020 and that were closed and announced later in the year. So there's that sort of delay factor. And I think that with COVID happening, I would expect that we are going to see a bit of a pause on the equity side of things in the equity landscape as investors wait to see how things play out. So that's, you know, that's one consideration. And then, you know, more broadly, I think that a lot of the large vertically integrated businesses in the space have done very significant equity raises over the past 18 to 24 months. And so it could be that they in fact don't need to go out into the equity market. And again, what is a very frothy equity market where pricing risk is difficult to do. And the way you price that risk is through the valuation exercise. So I think any business that can hold off is going to do so for a little bit, at least in terms of bringing in new equity. So I think on balance, we'll probably see you know, that continued lower level of equity for a bit of time until things fully rebound on the investor side.
Yeah, thanks for that. I think it's time. Can we launch the poll results to get the feed? So yeah, here we see that majority of the people think that the off-grid solar investment market is growing steadily, and that's quite an overwhelming majority. Yeah, any reactions to that? To that, Dan and Koen, but maybe starting from Dan.
No, I think that that's not surprising, and that mirrors what the investors that we surveyed said as well. And I do think that there's more than a decade in, I think there's a pretty strong view that the sector is continuing on the right path, and that is a path of steady growth.
Yeah, Laura, I kind of echo that. I think when we came out of our big forum in Nairobi in February, we took stock. We looked back, congratulated ourselves with what we achieved in a decade, but also look back and say there's bigger challenges lying ahead of us. We're ready to take that on. We should move towards, should change gear and move into a next level of skill and speed. COVID has stopped it in our tracks for a while. But the much of the capacity of the industry to deliver, I think, is still there. So I hope we can bounce back strongly with the support of investors, donors, governments, all the sector stakeholders. We should be able to come back quickly. And if, as industry, we get our act together, then I'm very confident that we will see continued growth for a few more years.
Thanks for that. I think this is going to be the last question, and we'll try to address the next ones privately. But there's one for both of you to reflect on as well. How do you see the significance of the concessional funds in the pipeline, like the Energy Access Relief Fund and the AFTV COVID recovery platform and others that we are seeing? So Dan, I'll give the floor to you first for this one.
Thanks, Laura. I mean, I think that those facilities are still relevant and are going to be crucial going forward. I think that, the COVID and its impacts, I mean, the industry has done well in facing the first wave, and I think there's going to be subsequent waves. And I suspect that on the investor side, there's going to be a limit to their willingness and ability to continue to support businesses in their existing portfolio. So I do think that it's really critical that those facilities are put in place, and I'm sure that they will be very, very well received and very well subscribed by companies themselves.
Yes, same here. I think the fact that investment and particularly debt funding has been holding up relatively well doesn't mean that there's still a lot of companies that are really screaming out for finance. And so I definitely think that these facilities are very helpful to plug gaps that exist. And once again, Gogla is not here just to support the big number of companies or the big number of investments. Our interest is to make sure that we have a healthy industry that is made up of a mix of companies, small and large, innovative or more established. Well, they're still innovative, but we need a healthy mix of the industry, and it's in our industry. It's in everyone's interest that all the players are having access to finance and an opportunity to grow and succeed. And I think these facilities are really super important to make sure that we can leave the blow from the COVID situation behind us as quickly as possible and move back to that growth trajectory that we wanted to be on.
Well, thank you both for your answers, and thanks for participating in the webinar. It's almost time, so we'll need to close, and we'll address the questions later on. So thank you, Dan, and thank you, Koen, for your contributions. And then once again, I'd like to thank GetInvest for making this research possible. If you have any other questions, comments, or feedback, you can reach out to Dan or to myself on this. And then you can move to the next slide. I'll there's more coming. So we have a new report launch on the 14th of October for the Global Off-Grid Solar Market Report, Semi-Annual Sales and Impact Data. And we'll have a webinar discussing those findings on the 22nd of October 2020. So we'll encourage you to register as we keep on developing and monitoring the signs of where the industry is at after during COVID-19. So thanks everyone for participating today in this webinar, and wish you all a very good evening.
Thank you very much. Thank you very much, Dan.
Thank you.